First, please depart. Photographers, please depart well, please. Why do not disconnect the mics this time? All right. Let's start again. We're going to start with Mr. Hennessy. Your 10 minutes, Mr. Hennessy.
Great. Thank you, Mr. Chairman. Chairman Greenspan, I want to focus on Fannie Mae and Freddie Mac's role in creating or exacerbating the explosion of bad subprime mortgages, and specifically on their portfolios. Now, it's possible that not everyone watching has read your written testimony, so I want to, if I can, try to summarize how I understand that part of your testimony, and then I want to ask about a specific House action from 2007, which I think contributes to this. As I understand it, Fannie Mae and Freddie Mac held huge portfolios of securities that they issued on the order of about $600 or $700 billion each. These portfolios were undercapitalized, and they ultimately led to Fannie and Freddie's collapse. In October of 2000, the Department of Housing and Urban Development significantly raised the affordable housing goals they set for Fannie and Freddie. Fannie and Freddie chose to meet those new goals by dramatically increasing their purchase and holding of securities backed by subprime adjustable rate mortgages. Your testimony says that in 2003 and 2004, they bought about 40% of this market, 5 times more than they did in 2002. And at the time Fannie classified these mortgages as prime, in September of 2009, they reclassified much of that portfolio to be subprime. Now, as I understand it, this huge increase in demand from Fannie and Freddie in 2003 and 2004 contributed to a decline in long-term mortgage rates relative to Treasuries. That decline in long-term mortgage rates helped fuel the rise in housing prices. And then when that housing price bubble burst, it hurt not just people who owned adjustable rate mortgages, but also fixed rate mortgages as well. Now, in February of 2004, and what we're talking about here is we're both talking about the GSEs holding huge portfolios, in effect, multi-hundred billion-dollar hedge funds on top of their guarantee and securitization business, combined with new affordable housing goals set in the fall of 2000. Now, in February of 2004, you testified that, quote, GSEs need to be limited in the issuance of GSE debt and in the purchase of assets, both mortgages and non-mortgages that they hold. That was in 2004. In 2007, the Congress considered the Housing Finance Reform Act, and the bill that came out of Chairman Frank's committee gave the new housing finance regulator certain authorities. And because it's important, I want to read the language. What that language said is that the director shall consider any potential risks posed by the nature of the portfolio holdings. That's it. Okay, so the new regulator should consider the risk of these multi-hundred billion dollar portfolios when he or she is evaluating Fannie Mae and Freddie Mac. Now, there was an amendment. It was House Amendment 207. It passed the House on May 22nd, 2007, on a 383 to 36 vote. That is an overwhelming bipartisan vote. And what that amendment did is it limited the new housing regulator's authorities. It said that the new housing regulator can only consider the risk that these portfolios place to the safety and soundness of Fannie Mae and Freddie Mac, not to the financial system as a whole. What I want to do is I want to read to you language from the sponsor of the amendment, Mr. Neugebauer. He said, "This legislation clarifies that when the regulator looks at regulating this entity, that he looks at the safety and soundness of that entity and not external factors." He later says, "We shouldn't put things out there that the regulator is not able to, quite honestly, articulate, because what is a systemic risk? That becomes a point of order that sometimes the regulator cannot explain exactly the systemic risk is they believe it is. It is a way to limit their portfolios." So in effect, 221 House Democrats and 162 House Republicans voted to preclude the regulator from being able to consider systemic risk with the GSE portfolios. This is directly contradicting your recommendation of February 2004. Suppose it had gone the other way. Suppose that housing regulator had had the authority to limit the GSE portfolios in 2007 and had exercised that authority. What effect do you think that might have had on the crisis?
Well, let's go back a number of years, because the original mandate of Fannie and Freddie was read as securitization solely, and that the accumulation of portfolios of assets was not in their business plan. With the onset of, I guess, a cynical view of the market, that the presumption that Fannie and Freddie were not backed by the full faith and credit of the United States government, and that cynicism basically led to a 20 to 40 basis point subsidy in their debentures and short-term debt, which for a financial institution is huge. And so the procedures that were involved with Fannie and Freddie were largely to build up the asset side of the portfolios. It almost didn't matter what they held, just so long as they harvested the subsidy. That created huge profits, huge rates of return on equity, and set into place a very large component of potentially toxic assets. And the failure of Fannie and Freddie was a major factor in the crisis, remembering it occurs prior to the Lehman default. And the result of that is that the combination of the system breaking down had extraordinarily large effects, which are difficult to judge because you only have a single incident. You can't say what would have happened if. But there is no doubt in my mind that if Fannie and Freddie had held only those mortgages in its portfolio which were required to make securitization feasible, they have to hold a certain amount of inventory, which is a very small fraction of what they actually held. If that didn't happen, they would not have failed. And the lack of that particular event, which is a very important event in the evolution of the crisis, may have headed it off. I don't frankly know. I don't know how one would know. But that we would have been far better off, in my judgment, is unquestionable.
Okay, thank you. And a secondary point, as I understand your testimony, part of what you're suggesting is that to meet the higher affordable housing goals set in October of 2000, Fannie and Freddie increased their purchase of specifically subprime ARMs. They classified them at the time as prime. They reclassified them later. We have the former head of Fannie Mae coming in, and we have the former regulators coming in. What would you recommend we ask them about the interactions of these housing goals and the actions that they took in 2003 and 2004?
Well, I would ask them, other than making profit for the corporation, what was the purpose of accumulating the assets in their portfolio? The reason I raised the issue is I never got a straight answer in the early years that I was involved with them. And I think this is an unfortunate event, which, as far as I'm concerned, had it not occurred, namely the huge accumulation of assets, for a lot of different reasons, including potential distortions in the marketplace, we would have not have had, incidentally, the big affordable housing purchases by Fannie and Freddie, because it's based on volumes, and the amount of Fannie and Freddie, as it turns out, ARMs that they bought would have been very much less, and that would have removed a very substantial amount of weight on on the subprime market. Because remember, that mandated demand, it's mandated, remember, that mandated demand took out effectively as a first tranche 40% of a market. And when you do that to any market, it has extraordinarily major impacts. And I cannot but believe that even with the affordable housing goals, with a far smaller Fannie and Freddie portfolio, that would have run into the extent of the types of problems we were to run in 2008, for example.
Thank you.
Thank you very much. Ms. Bourne.
Thank you. Mr. Chairman, you long championed the growth of the over-the-counter
Excuse me, could you put
derivatives
your
market.
microphone a little closer?
Is your mic on, Ms. Bourne?
It is on,
Oh,
yes.
Now we hear you.
You've long championed the growth of the over-the-counter derivatives market because of the risk-shifting opportunities that it provides. You've also taken the position that over-the-counter derivatives market should not be regulated. As chair of the Federal Reserve Board, you endorsed a President's Working Group report in November 1999 calling on Congress to eliminate regulation of the OTC derivatives market. You then welcomed the adoption of the Commodity Futures Modernization Act of 2000, which eliminated virtually all federal government regulation of the OTC derivatives market and also preempted certain state laws relating to it. So as a result, OTC derivatives have been trading with virtually no regulation for a decade, and the market grew to exceed $680 trillion in notional amount by the summer of 2008. In your view, did credit default swaps, which are a type of over-the-counter derivatives contract, play any role in causing or exacerbating the financial crisis?
Well, first, let's remember that in the early years, credit default swaps were an extremely small part of the total notional value. And indeed, the arbiter or the collector of international data, the Bank for International Settlements, didn't find credit default swaps of sufficient volume to show them as a separate category until the end of 2004. And if you separate credit default swaps from the rest of the market and look at the rest of the market essentially as interest rate derivatives and foreign exchange derivatives, which it still is, you have the remarkable phenomenon of these unregulated derivatives having the most extraordinary stress test in 2008, 2009, with no evidence of which I am aware that they didn't work as exactly as they were going to. It is certainly the case that credit default swaps did create problems, and indeed, the Federal Reserve Bank of New York was probably the very first group to really come to grips with the problems in 2005. So if you go back to the earlier periods, the credit default swaps were never discussed in the President's Working Group, to my knowledge. When we talked about derivatives, we were talking about essentially interest rate derivatives and foreign exchange derivatives. And they have been unregulated, to be sure, and no problems have emerged as a consequence of that. Credit default swaps are a more complex issue, but they were not on the agenda in the early years when we had these discussions at the President's Working Group.
Well, they certainly existed as of that time. I think there is a August 12, 1996 supervisory guidance for credit derivatives that was issued by the Federal Reserve Board. to the banking community about the use of credit default swaps and other credit derivatives. And certainly, if you've read Gillian Tett's book called Fool's Gold, it talks about the extensive activity in credit derivatives, including some very creative things that J.P. Morgan did in 1997. Are you aware that the collapse of AIG was caused by its commitments under credit default swaps that it had issued? The taxpayer has had to bail out AIG because of its exposure on credit default swaps to the tune of more than $180 billion.
Well, first let me respond to your 1997 reference. I can't give you an exact number, but my recollection was that there was credit default swaps something like 1% of the total notional value of all derivatives, and that the mere fact that it was being discussed is something which is to be expected. But if you're evaluating their impact on the economy and on the financial system, 1% or less in notional value is not a big factor in anything. With respect to AIG, it is correct that they're offering and selling vast amounts of credit default swaps was the proximate cause of their problem. But they were selling insurance. They could just as easily have sold and gotten into the same trouble by issuing insurance instruments rather than credit default swaps. My understanding is that the reason they did that is there was a differential capital requirements, but that is not an issue of the credit default swaps per se. The issue was the extraordinary behavior of investment officers at AIG who took unbelievable risks with essentially very little capital. There is a difference between credit default swaps and, for example, interest rate derivatives in the sense that credit default swaps insure the principal as well as the interest. Interest rate derivatives, for example, only deal with interest and are therefore far less subject to the problems that exist when you're insuring the level of principal as well as interest.
Mr. Chairman, the market for credit default swaps had risen to $60 trillion in notional amount, equal to the gross domestic product of all the countries in the world by 2008. Also, let me point out that had these been being sold as insurance products, they would have been regulated by insurance regulators and supervisors. There would have been a requirement of capital reserves. There would have been a requirement that these contracts could only have been sold to entities that had an insurable interest, that is, held the bonds or securities that were being insured against. There was no such regulation in the OTC derivatives market, thanks to the action of the President's Working Group and Congress in 2000. Let me go on to another subject. In your recent book, you described yourself as an outlier in your libertarian opposition to most regulation. Your ideology has essentially been that financial markets, like the OTC derivatives market, are self-regulatory, and that government regulation is either unnecessary or harmful. You've also stated that as a result of the financial crisis, you have now found a flaw in that ideology. You served as chairman of the Federal Reserve Board for more than 18 years, retiring in 2000, and became, during that period, the most respected sage on the financial markets in the world. I wonder if your belief in deregulation had any impact on the level of regulation over the financial markets in the United States and in the world. You've said that the mandates of the Federal Reserve were monetary policy, supervision and regulation of banks and bank holding companies, and systemic risk. You appropriately argue that the role of regulation is preventative. But the Fed utterly failed to prevent the financial crisis. The Fed and the banking regulators failed to prevent the housing bubble. They failed to prevent the predatory lending scandal. They failed to prevent our biggest banks and bank holding companies from engaging in activities that would bring them to the verge of collapse without massive taxpayer bailouts. They failed to recognize the systemic risk posed by an unregulated over-the-counter derivatives market, and they permitted the financial system and the economy to reach the brink of disaster. You also failed to prevent many of our banks from consolidating and growing into gigantic institutions that are now too big and or too interconnected to fail. Didn't the Federal Reserve System fail to meet its responsibilities, fail to carry its mandates?
And by the way, on this, I'm going to yield 2 minutes for the response. We're over time.
First of all, the flaw in the system that I acknowledged was an inability to fully understand the state and extent of potential risks that were as yet untested. We didn't see what those risks were until they unwound at the end of the Lehman Brothers bankruptcy. And I had always presumed, as did virtually everyone in academia, regulatory areas, banks, presumed that risk potential was. Having failed there means that we were undercapitalizing the banking system probably for 40 or 50 years, and that has to be adjusted. But the notion that somehow my views on regulation were predominant and effective as in influencing the Congress is something you may have perceived. It didn't look that way from my point of view. First of all, I took an oath of office to support the laws of the land. I don't have the discretion to use my own ideology to affect my judgments as to what the Congress is requiring the Federal Reserve and others to do. As far as I'm concerned, if somebody asked me my view on a particular subject, I would give it to them, and I expressed them in the book you're referring to. But that is not the way I ran my office. I ran my office as required by law, and there's an awful lot of laws that I would not have constructed in the way that they were constructed, but I enforced them nevertheless, because that was my job. That was built into my oath of office when I took over the Fed's chairmanship in 1987.
Thank you.
I know my time has run out, but I really fundamentally disagree with your point of view.
All right. Good. Thank you. Mr. Thompson.
Thank you, Mr. Chairman.
Microphone, Mr. Thompson.
Thank you, Mr. Chairman. Dr. Greenspan, thank you for joining us this morning. I'd like to go back to the line of questioning that Mr. Giorgio raised regarding regulatory arbitrage, if I might. You said in the Brookings paper that regulators can, and I quote, prohibit a complex affiliate and subsidiary structure whose sole purpose is tax avoidance or regulatory arbitrage. It's clear from our view of Citi that that was in fact part of what drove some of their decisions as they looked at opportunities. So how should supervisors have prevented this regulatory arbitrage from occurring prior to the financial crisis?
Well, to a large extent, it's caused by the legal structure of these organizations. You know, one of the problems that exists is that people are concerned about off-balance sheet accounting. That's not what bothers me. What bothers me is if you take something off your balance sheet, you should be prohibited from bringing it back. And I cannot believe that people secondarily thought that reputation risk all of a sudden emerged. They didn't know about it. So I think there's a bit of dubious bookkeeping going on at that particular point. But if the regulators can determine what type of subsidiary structures you can have in a large organization, you can eliminate a fairly significant amount of the regulatory arbitrage. And it's not an economic issue. It's basically a means by looking at what the capital requirements or other requirements are and figure out how you would structure the various subsidiaries of your organization to avoid that. That is in nobody's interest.
So financial innovation has been an important component of what's driven the contribution to GDP growth from the financial services sector over the last 20 years or so. If you were to think about other industries that have significant societal impact, pharmaceuticals, transportation, a range of others, they are required to test their products and have those products certified before they release them into the marketplace. So if we were to now think about the societal impact of financial services and your views around collateral and capital, should there be a different scheme for new product introduction in this industry that would mitigate perhaps the societal impact that some of the risk we're taking really represent today?
Well, that's a good question. I think you first have to start off with the question of what's the function of our financial system? And basically, it's to supply financial services to the non-financial sector, Main Street, so to speak, which facilitates the production and standards of living that emerge as a consequence of that. For example, we have an extraordinary rise in the share of national income going to finance starting in 1947, year after year after year. And so what we're dealing with is a major problem in how to make judgments of what is innovation that works and what is it doesn't work. But that you need innovation to essentially keep up with the complexity of the non-financial economy, it goes without saying. All innovation, by its nature, is unforecastable with respect to how it'll come out. So I think what we find in finance, as well as in the non-financial area, is that a large number of innovations fail. But fortunately, what causes progress in productivity is that more innovations are positive than otherwise. You cannot tell in advance which is which. So my judgment is the only way to solve that problem is to have enough capital that will absorb X% of innovations failing. We will never see SIVs or synthetic CDOs as far in the future as I can imagine. They're gone. The critical issue here is investors who determine what products fail and what succeed. It's not the banking system. The banking system can offer them, but if they don't buy them, there's no use. So the non-financial part of our economy is the arbiter of what products fail and not fail.
So would you therefore be an advocate of some form of incremental capital being put in place ahead of the release of these critical new innovations?
As a general rule, I'm not comfortable with variable capital changes, whether it's for, I mean, the main argument is usually that there's cyclically adjusted capital requirements. That would be fine if we could forecast where in the business cycle we were in real time. We're always very thoughtful on the issue of where we were in the business cycle. But it's a wholly different issue when you're in real time and saying, are we in the beginning of the cycle or are we closer to the end? And I think to simplify...
Well, for new products, we would clearly be at the beginning of the cycle.
I'm sorry?
For a new product innovation, we would
Yes.
clearly be at the beginning of the cycle.
Yeah, no, I'm referring to the business cycle generally.
Okay.
But I agree with you. In other words, that every innovation always starts at the beginning, and you don't really know where it's going to come out, and the non-financial system will tell you whether it's valuable to them. And I would just as soon not try incremental. I have nothing in principle against it. It's just that I feel it's not easy to implement.
Well, you commented this morning that the issue of consolidated regulatory scheme had been discussed for years within the Fed and I guess amongst the peer agencies. And it's your opinion that there's no evidence that would suggest the change to consolidating the regulatory scheme would in fact help. Therefore, should I conclude from that comment that you, as someone who sat over and was the standard bearer, if you will, for our financial system for almost 20 years, believes that no meaningful change is necessary now?
I don't know the answer to that question because we've got so many overlapping jurisdictions and the like that are frankly kept that way for political, not economic or financial reasons. And I have no doubt...
But politics aside.
I'm sorry?
Politics aside.
Politics aside, yeah, I've always thought that there are differing things that could be done, but I want to emphasize that it's not the particular agency which does the things, but more importantly, what is done than who does it.
So you strongly believe that incremental capital and incremental collateral would help? I interpret that from your comments.
I would say I'd be more inclined to just set absolute levels. There is a problem with changing capital requirements, largely because it creates an element of uncertainty in the marketplace, which probably, I have no idea how big it would be, but it's certainly negative. I think that you're far better off just fixing capital requirements at levels and just holding them there as permanent requirements. I think that would address, in my judgment, most of the problems I see that are out there.
While I would tend to agree with that, it would also seem to me that combining the notion of supervisory as well as enforcement would also help, because you indicated that in many instances, while the Federal Reserve had supervisory responsibility, you really did not have enforcement. So I'm not sure how the system works and improves without us making some changes, not just in capital and collateral, but in how we execute on the rules and laws that we have in place.
Well, I think in order to do that, if the Federal Reserve were required to enforce the rules and regulations that it promulgates, I think the staff would have to be vastly larger.
But some other part of government would also have to shrink.
Well, there's right now, there's a great deal of discussion that's going on with respect to who should be supervising what. And the problems that I'm not sure that we solve any of the problems that have been properly identified in this crisis by moving the chairs around. I do not deny that if you asked me, starting from scratch, would I have a different type of regulatory system focused on the areas where I think they can be most effective? The answer is I suggested that in the Brookings panel piece where I went through the reasons why, what regulations can do and what they can't do. And if we emphasized what we can do, which can be very effective, and in my judgment, determinative, what you tend to do is to cause the losses to be concentrated in the common shareholders of institutions. And if capital is large enough, all of the losses accrue to them and not to the debt holders, and therefore they do not default, and therefore you don't have serial contagion, which is caused by defaults of senior debt mainly, but debt in general.
Right.
Yeah,
Thank you
unfortunately,
very
we
much.
don't have the luxury of being able to start over from scratch. And so I think we're going to have to implement incremental changes, and your knowledge of the system and what changes would be beneficial to the American public would be very helpful.
Thank you. All right. Now, Mr. Thomas, you and I have some remaining time. Do you want to, should I go ahead and take my just cleanup items, then turn to you?
Well, I would advise you that, setting politics aside, as chairman, you should let me go first,
You go ahead, Mr.
and then
Vice
you
Chairman.
get to close, although I'm very tempted by that invitation.
Go ahead, Mr. Thomas.
Thank you. I would just tell my, my friend that setting politics aside is a sure invitation for politicos to show you that you can't. And,
it's hard to do here.
And we've seen that over and over again, just the way the system works. And if you're going to start with a clean sheet of paper, it means you have it turned over. You really need to turn it over because there is no such thing as a clean sheet of paper. Mr. Chairman, this is a question that I will ask you that I don't need you to answer now. You might want to do it on paper to me. If you don't, and you can offer a reasonably short version, that's perfectly acceptable. And the reason I put it in that context is that your mention of the book, Reinhardt and Rogoff, I serve at AEI with a colleague who is the husband of Professor Reinhardt, Vince Reinhardt. And in discussions that we've had, he's indicated in his position, and I should give a bit of background, he's the head of the monetary affairs at the Fed from 01 to 09. And he's talked about the fact that he thinks, based on his knowledge and experience, that the Fed made a mistake signaling to the market that it was going to slowly raise short-term rates. And the argument goes that this created a steep yield curve because the market, as we saw over and over again, quickly adjusted to where they knew the rates would eventually go. And the steep yield curve led to novel ways for firms to take advantage of borrowing very short term and lending long term. You agree with that analysis? In retrospect, was the Fed's strategy the right one to take? Or is it the usual argument at the time, given the information we had and under the circumstances?
Well, Vincent Reinhardt is a first-rate economist and whose judgment I have for many years relied on. Let me answer that question in writing after I go over the particular details of the position I know he's taking.
And I wanted to offer that to you because I am interested in a more fundamental answer because it will lead to other questions as we go forward. So thank you. And we'll submit it to you in writing.
Additional questions, Mr. Thomas?
Not at this time, Mr.
All right. All right, a couple of items. Just, first of all, a couple of clarifications, because I just want to make sure we have the facts for the record. Even by your own submission, and by the way, let me stipulate that Fannie Mae and Freddie Mac were disasters. But I just do want to point out, because you keep referring to 40% of the market, that if you look at that 2002 to 2005 period, the private market, Wall Street, was anywhere from 59 to 92% of that private label security market. That's just a fact. Secondly, I did want to just follow up on Ms. Murren's question of earlier. I just wanted to point out, because when she referred to the review of the Federal Reserve Bank, and I don't think there's any expectation you would have seen this review from 2005, but this was not some third-party wild-eyed critic. This 2005 review, which Ms. Murren referenced, was a peer review by other Federal Reserve banks, and I might say there was a second review in December 2009 where, again, the peer other Federal Reserves commented on the supervision of Citibank by the Federal Reserve Bank in New York, and they said, quote, "The supervision program for Citigroup has been less than effective, although the dedicated supervisory team is well qualified and generally has sound knowledge of the organization. There have been significant weaknesses in the execution of the supervisory program." So I just wanted to point out that these were internal reviews as to the inadequacy of supervision. But I do want to return to just one line of questioning that I asked you that I want to follow up on, because you indicated that in many respects what was important was to go after fraud, embezzlement, illegal activities, and you've been very clear on that. So very quickly, there was the FBI warning in 2004. There was a seven-fold increase in the number of suspicious activity reports related to mortgage fraud by banks from 2003 to 2006. Your own Federal Reserve in 2005 put out a white paper on the detection, investigation, deterrence of mortgage loan fraud. Just very quickly, what was the most important thing you did to combat fraud? The single most important thing that the Fed did in light of the evidence that it was growing in mortgage?
Well, first of all, the enforcement against fraud and misrepresentation is one of the key elements in any market society. You cannot have an effective market society if counterparties cannot trust individuals with whom they're dealing wholly independently of what their contractual relationships and enforcement is. The FBI's, I believe they had 22,000 cases in 2005. That's important and critical. One issue of fraud is enough, but 22,000 when you have 55 million total mortgages outstanding, residential only, home mortgages, as well as a lot of commercial mortgages, it's not a systemic problem.
But did you then make any actions? I mean, I could only count 2 referrals under fair lending laws from 2000 to 2006 by the Fed to Justice, just 2. One for First American Bank in Carpentersville, Illinois, and one for Desert Community Bank in Victorville. It seems pretty slim.
Well, the issue was that the staff, in evaluating what was going on, which, see, remember, a goodly part of supervision and regulation is to get things solved so that if somebody is in violation of something and you can get them to adjust so that the regulators are satisfied, it never gets to the point where it's a referral for enforcement of some form or another. I agree with you in the sense that the number of actual referrals that were made to the Department of Justice were small, and I believe a good reason for that is we were able to get compliance without doing that.
All right. Well, here's my final observation. It really follows up on Mr. Giorgio's questions and Ms. Bourne's. And I'm going to ask you to, in the remaining time, just to, I think, deal with something that's very significant around which I think a lot of Americans have questions.
We have a problem with our live coverage. We're working on it and plan to return to the event shortly.
As you can see, there has been a power outage in the room. The Financial Crisis Inquiry Commission, in its first of several days of hearings focusing on subprime mortgages this week. Again, power's out, the lights are out, somebody trying to open some curtains so the commission can continue its work today. We're continuing our live coverage this afternoon. In fact, the event will continue as a panel on subprime loans, on how subprime loans are originated and how they're packaged for sale on the market. That'll be coming up this afternoon, followed by a group of former Citigroup risk managers on their company's subprime products. And then later this week, on Thursday, our coverage continues tomorrow with former Citigroup executives. And then on Friday, former Fannie Mae executives appear before the commission, starting both days live at 9 a.m. Eastern Time here on C-SPAN 2.
For 50 years, spawned.
Again, back in the room where power is out, the shades are open to shed a little light on the Financial Crisis Inquiry Commission, continuing its work now through this power outage. Alan Greenspan, the former Fed chair, is testifying.
Major mistake. Is it an indictment of the total system? By no means, because it's not the conceptual framework of how to regulate, but the actual application of it. We did not have enough capital in the system to contain the type of crisis which, in my judgment, happens once in 100 years. This financial crisis, as best I can judge, is the most severe in history. It's not the same thing as saying that it's the severest economic crisis. That was the Great Depression. But there is no examples that I've been able to find of a breakdown in short-term financial availability, which is the critical issue in a financial crisis, in any history that I can see on a global scale that occurred within days following the Lehman Brothers bankruptcy.
Mr. Vice Chair.
On that statement, Mr. Chairman, I would ask you a follow-up question, and that was quite a contextual position for your statement, that you do not, given your background, understanding, history, see any comparable collapse. In that regard, I'd have to say, notwithstanding the difficulties we're still in, the experiences that we had previously, in my opinion, I want your reaction, allowed us to take some actions which mitigated, notwithstanding all of the damage that has been done, an even greater crisis. Is that accurate?
I'm sorry, may I answer that for the record, if you don't mind?
For the record, because I think at some point the whole concept of bubbles is you didn't know, you didn't anticipate, this time is different. If this is to the magnitude that you indicated different than in the past, notwithstanding the damage, all of the understanding of what we need to lead to, it could have been worse.
Well, this is the critical period that we're going to have to look at how this thing ultimately evolves before we fully understand what the consequences are. But let me respond to your question in more detail on the record.
Thank you. Certainly yield a minute to Commissioner Giorgio.
Just one question I would ask you, and I'd ask you to respond to it if you could in writing. Our capital, I think we've all come to the conclusion that, and your advice has been, that the capital and liquidity requirements historically weren't adequate to avoid the consequences of the financial crisis. And I take it that means that we ought to implement some more significant capital requirements on a go-forward basis. That'd be fair to say?
Mr. Chairman, these questions can be recorded, but I think they ought to be answered in writing,
Right.
given the current circumstances.
I understand, but I thought he nodded his head yes. Is that correct?
No.
The witness can't hear. We had a hard stop.
And I believe Mr. Wallinson wants a question for the record, and we'll submit these in writing. If you can phrase it.
Quickly, yes.
Yes.
And my question is this. The unprecedented thing about our current situation is the total number, it seems to me, of subprime and Alt-A mortgages in our economy. 26 million, which, as I said at the outset, is about half of all mortgages in our economy. When you are responding in writing to the question of what caused this financial crisis, I would like you also to consider whether, in addition to less capital than was required, what effect this substantial number of bad mortgages might have had.
So those will be submitted in writing to Mr. Greenspan. And look, I just want to say, Mr. Greenspan, you gave a lights-out performance today. But I want to thank you very much for your time. Thank you very much for coming before us. Thank you for your service to the country. And we are going to adjourn for 30 minutes, and hopefully we will have lights and power when we return. Thank you all very much.
Thank you very much.
You're watching the first of several days with the Financial Crisis Inquiry Commission as it focuses on subprime mortgages. Former Federal Reserve Chairman Alan Greenspan testifying this morning. The lights on for most of this morning, but a power outage for the last few minutes or so. A lunch break now, but still to come in about a half hour or so. A panel on how subprime loans were originated and packaged for sale on the market. And that'll be followed by a panel of former Citigroup risk managers on their company's subprime products. All that coming up this afternoon. We'll have live coverage here on C-SPAN 2. And our coverage continues tomorrow with former Citigroup executives testifying before the commission and